Well, the 25 basis point hike was well forecasted, but I think the Fed did give us a little surprise. It made a move towards guiding us towards 3 rate hikes next year, and there was a broad move among members in that direction. So I think the idea that the Fed is telling us not only that it moved yesterday, but that it's got work to do, it believes, for 2017 was the surprise. It seems to us consistent with what we're seeing in the economy. We'll see where the data goes from here.
Even if the U.S. economy, Bruce, can handle 3 rate hikes next year, can China, can the emerging markets, which are already having a pretty weak month, and there are many equity markets there that are already in correction?
Well, I think the key here is whether we're right that there's a broad shift away from disinflationary forces at work here, that global manufacturing is picking up, that commodity prices are firming, that we're shaking off the problems of the last couple of years. EM economies don't need higher rates. The Fed tightening will be a constraint on them. But if it's being offset by a stronger global economy, I think we're going to be OK in that mix.
Bruce, in terms of what we can expect for GDP growth moving forward next year, clearly the Fed not as upbeat as maybe where the market had got in terms of that regards. What's your and JP Morgan's latest forecast for next year?
Well, we have the economy gliding at about a 2% pace over the next few quarters. It's not very far from where the Fed is. We don't think we're going to get big fiscal stimulus, certainly not in the early part of 17 and probably not even later. So we're not building in a big move on the policy shift side. I think the big call here is, in our mind, a 2% economy still tightens the labor market. It still puts some upward pressure on inflation. And that's the dynamic in a world in which Fed policy rates are still very low.